hire a team of lawyers to handle the documents to sell a small part of your holdings to your employees every time you needed to do that, but that just doesn't make sense. It'd be too expensive and time-consuming. Going public solves that problem. When a company grows to more than 500 shareholders, then it has to start filing a lot of documents with the SEC. Sometimes private companies decide that once they have to incur the cost of doing that, then they might as well take the plunge and go public. For example, Google went public about the time that it had to begin filing SEC documents in 2004. Keep your company founder's hat on for another minute. Suppose that business is good, and you could probably double earnings over the next couple of years if you could open a branch office and manufacturing facility in another part of the country. But that sort of expansion isn't cheap. Where are you going to come up with, say, $300 million? This is probably the main reason for having an IPO, to raise funds and have better access to capital markets going forward. You'll also attract the attention of analysts and pick up some credibility with customers, suppliers, and employees. Going public has drawbacks, though. IPOs require lots of legal work, and that's not cheap. The total direct costs associated with taking a firm public are about 7 to 10% of the amount of money raised, and that doesn't include indirect costs like management time that gets diverted from other corporate needs. I mentioned that IPOs require lots of legal work, so how does a company set about going public anyway? In principle, it doesn't sound too hard, does it? Just create the shares on a computer and sell them. How hard can that be? It turns out that simply issuing shares and selling them leaves out two important things. First, there's the legal system. The government won't let you issue shares and sell them without jumping through the appropriate legal and regulatory hoops. Maybe those hoops are a good idea, and maybe they're not, but they exist, and you have to jump through them or you're not going public. Second, what's the share price going to be? Remember lesson 12 when we tried to get a handle on corporate and share valuation? We learned that it was really hard. It's next to impossible for a private company. For a public company, we have lots of data and a reference point, the price history of the shares. We can't do that with a private company. The stakes are higher too. If you sell 2,500 shares from your personal portfolio and settle on a price that's $2 too low, then you've left $5,000 on the table. An IPO might have 25 million shares. A mistake of $2 per share would cost you $50 million. We need help. We need somebody who has done this before. In fact, we need somebody who does this sort of thing a lot. We need an investment bank. That's a financial institution that serves as an intermediary between the securities issuer and the investing public. They decide the best offering price. Investment banks also help with mergers and corporate reorganizations. Investment banks even provide advice before they start the issuing process. They might help us determine the size of the issue, or perhaps suggest that we delay the offering until market conditions or the company's prospects improve. Investment banks engage in a process called underwriting. Members of underwriting syndicates usually take the responsibility for selling the shares the company allocates to them at a specific price. The origins of the word underwriter seem to trace to a practice of having each risk taker write his name under the total dollar amount of risk that he or she was willing to accept. Today, it usually has a more general meaning, referring to the process by which investment bankers raise funds from investors on behalf of corporations. Want to know another reason for a company to use an investment banker when it goes public besides expertise and familiarity with the process? It's because IPOs are plagued with what financial economists call information problems. Remember when we discussed information problems in Lecture 3? In the case of an IPO, management knows a lot more than anyone else about the company's prospects, and they've decided to sell now, not last month, not next month. Why? now.